All right, it's 7:02. So thanks very much for coming to our seminar, Quality Investing for the Long Run, presented by Barry Schwartz, our Chief Investment Officer, and Ernest Wong, our Head of Research and Portfolio Manager. My name's Benjamin Klein, Senior Portfolio Manager and Head of Financial Planning. Barry, you can go to the intro page if you like. So just to tell everybody a little bit about the firm, Baskin Wealth Management's been operating for over 30 years, since 1992. We're completely independent and employee operated. We're managing about $2.5 billion Canadian in assets over about 1,000 or 1,100 client families. We offer fully customized wealth management for families and foundations and other institutions. We also offer no additional cost financial planning to clients of the firm. Every client of our firm has a dedicated portfolio manager and a portfolio associate. We try very, very hard, and we think we do an excellent job of customer service, and we know our clients really well. In terms of the firm itself, we have over 25 employees, including an investment team of 11 people. A quick disclosure that nothing that we say tonight is investing advice. There are also a handful of other disclosures that you should take a look at the end of the presentation. As for the structure of the evening, we're going to do the seminar, which will probably take about half an hour. We'll also have a question and answer period after the seminar. If you have any questions that you'd like answered, please use the Q&A function in Zoom. There should be an option down at the bottom of your window if you're on a computer next to participants and chat and raise hand. One of those options should be Q&A. So just click on that. You can type in your question and it will privately be sent to me and Barry and Ernest. If you have any questions with Zoom, you can also just send me an email. I'll do my best to monitor my inbox. My email address is bklein, B and my last name, @baskinwealth.com. And if there is any reason we can't get to your question tonight, feel free to send it along later, and we'd be happy to take a look at it. Without further ado, here are Barry and Ernest.
Thank you very much, Benjamin. I'm so happy that everybody could join us tonight. As I promised, I will try and keep this before the World Series Game 4 starts at about 8 o'clock, and so we'll get to your questions. So it's going to be interactive. Ernest and I will we'll try not to talk to you, but talk with each other about our favorite topic, which is investing. And so the title of the presentation is Quality Investing for the Long Run. And we hope what you'll get out of this presentation is learning a little bit about Baskin's strategy for investing, what quality investing means to us, where we think we can find quality investments, where we are today in the market, and giving some examples of some quality investments. So I think it'll be a really informative evening, and this will be recorded, and we'll put it up on our webpage as well as our YouTube site. And those that know us and follow our podcast, we'll be launching a new podcast tomorrow as well. So no end to the Baskin Wealth content. And once again, thank you very much. So as everybody knows, the World Series is on right now, Game 4. And just so happens that two of the teams with the largest payrolls seem to have made it all the way to the World Series. Is it a coincidence? Probably not. And that's really what we think about in terms of investing. Just like a baseball team, you can get the best players and pay the most amount of money for the best companies. And sometimes that can work out really, really well. What we try and do, of course, is to buy great companies, which at a reasonable price. So fill out our baseball team with great players, but try not to overpay for them. Because as you can see, sometimes you'll have an Aaron Judge who can't hit a baseball in the World Series, even though you're paying him a few $100 million. So with that, we'll start the presentation. So Ernest and I wanted to talk to you quickly about where we are today in terms of the market and our quick feelings. As everybody knows, next week, probably one of the most important elections in the U.S. that any of us have seen, of course. And as we know, lots of division in the U.S., lots of worries about what will happen. And we did a podcast just recently on our thoughts about the election, and we'll post it tomorrow so you can hear a more in-depth conversation. Obviously, we don't know what's going to happen there, but here's where we are today. We're in a bull market. Just today, the NASDAQ 100, the companies that make up the NASDAQ hit an all-time high. The S&P 500, very close to an all-time high, and here in Canada, also at an all-time high. So that's a bull market. And why are we in a bull market? Well, I think it's pretty clear. Inflation has come down to a very reasonable level. Interest rates are being cut around the globe. In Canada, we've seen material cuts in interest rates. In the U.S., We saw a couple interest rate cuts, or one interest rate cuts, and more coming for sure. In the meantime, the U.S. economy and Canadian economy are doing quite well. The U.S. is much more robust at the moment. Unemployment rates are falling. And most importantly, what we look at, corporate earnings, very, very strong. You know who's driving these corporate earnings. We saw one of them report those earnings tonight, which was Google. Just an absolutely fabulous earnings report. Company is actually, its growth accelerated to 15%, which is just mind-boggling given it's almost a $2 trillion company. Ernest, anything that I didn't catch there?
Well said.
All right, so we're going to move on. The one thing that is so shocking to us, and we've talked around our investment committee and to clients, is that over the last 5 years, everybody knows that the stock market has just done incredible. But if you and I were sitting 5 years ago, let's say October 2019, and I said to Ernest, over the next 5 years, we're going to have a global pandemic that shuts down the world, Ernest. We're going to have a Russia-Ukraine war. We're going to have an insurrection at the U.S. Capitol. We're going to have a global economic slowdown. We're going to have a supply chain crisis. We're going to have interest rates that reach the highest level that we've seen since the 1980s. Inflation reaching the highest level since the 1980s. And yet, don't worry, because the stock market, the S&P 500 will double over the next 5 years. You would have said I'd be crazy, but that's exactly what happened. And you can see here from the chart, for the past 5 years, the S&P 500 total return, that's including dividends collected, gone up 111%. That means it's a double over 5 years. Pretty incredible given how crazy the world events have been over the past 5 years. So that's the past, and that's where we are today. But as you know, we invest for the future. What matters, of course, is what's in your portfolio and how it will do going forward. Here are what we think are the risks and opportunities that are happening right now in the world. Of course, we talked about it, presidential election. We'll see what happens. We're praying for the best, lots of calm, and hopefully the market will do well over the long term. It'd be interesting to point out, of course, that the stock market has done very well under Trump. The stock market did very well under Biden. The stock market did very well over Obama. Yes, once every 3-4 years, we get punched in the face. We have bad performance, like 2022 or 2018 or 2015, you name it. But you can see that it's very hard to bet against America. It's hard to bet against Canada. The long-term performance of stocks has done very, very well. We have the ongoing conflicts in the Middle East and the Ukraine. I don't think that's going to end anytime soon. AI risks and opportunities, of course. We're having a big transition here in this world to the AI economy. All the Magnificent Seven companies are investing billions of dollars to try to increase productivity, to change the world. Whether it will work or not is anybody's guess, but these companies are doing what they said they're going to do, and that's spending lots of money. We saw today in Google's earnings report that its capital expenditures, that's the amount of money that it's buying stuff for its data centers, and is $13 billion in the quarter. Just an insane amount of money. We think Google's going to spend about $50 billion this year. Meta, which is Facebook, spending $50 billion. Apple's spending $10 billion. Amazon, $50 billion. Most of that spending, I think, Ernest, correct me if I'm wrong, is going to AI.
Yeah, CapEx for AI. Yeah,
correct. The other thing, of course, in a bull market is you have stocks that have done very, very well. And so as a result of the stock market doing well over the last 5 years, valuations are not cheap. And we'll be the first to admit it. When you're buying great businesses right now, you are paying a higher price than you have in a long time. But let's set the table. You can't have a great economy and cheap stocks. It doesn't work. Nor can you have, so we have a great economy. We have great corporate earnings. And as a result, stock market valuations reflect that. We have to be more cautious, obviously, going forward when picking companies to make sure that we can still achieve the rates of return we want for our clientele. We are also still wrestling with inflation. We have many companies in our portfolio and companies that we're reading about that are still, their consumers are still being impacted by high inflation. My son went out for dinner the other day to McDonald's. He got a combo meal. It was $17. I'm old enough to remember when the McDonald's combo meal was $4.99. So you can imagine the families are struggling with the cost of food, the cost And even though inflation has come down, it doesn't mean that food prices are going to come down from here. And of course, if they do cut interest rates materially, maybe we'll see a renaissance in the housing market. We have many companies, and we're seeing many companies that are being impacted by the slow movement in the housing sector. If interest rates come down, that may make housing again more unaffordable. So there's risks to the economy, and of course, there's other risks that we can't even prepare for, or are they're completely unknowable. But this is what's up top of mind for us. Ernest, anything to add?
Nope.
So just here's a quick chart on just to give you some more visuals on investing. You know, the famous Charlie Munger said that investing is not easy. You know, it can be simple. You can buy good companies, but it's not easy because every few days, every few weeks, there are world events that are scary, that may be material, that may make you want to make changes to your portfolio, right? The world shut down in 2020. You probably would have wanted to make extreme changes to your portfolio. Are people going to travel again? Are people going to go out to eat again? Are they ever going to go to a movie or a concert again? You know, and those stocks were deeply impacted at those times, but many of those, you know, travel or hospitality companies are now trading at all-time highs. So you never know how humans and the world is going to adapt to any of these events. So here's just a snapshot, I hope you can see, of some of the crazy things that have happened over the last, I don't know, call it 16 years. And over the last 15, 16 years, the S&P 500 and the NASDAQ have been the best performing indices as a result of strong profits from U.S. companies. Ernest, you want to take it away?
Yep. And so at Baskin Wealth, our portfolios are largely focused today on Canadian and US stocks. And this has served us and our clients very well over the last 15 years because, as you can see on this chart, the blue line is the US market, the S&P 500. And it has quite handily outperformed both emerging markets and developed markets outside of the US. I think the natural question that a lot of people have then is, well, should we sell the US and buy emerging markets? Should we go to China? Should we buy European stocks? Or should we even buy more Canadian stocks? Next slide.
Yeah.
Yeah, and you see a lot of people on CNBC and like in the Globe and Mail, like they say things like, well, like US stocks are just in like an all-time bubble. You can't own US stocks. You got to go to China. You have to own small caps. It's just 7 companies driving the market. And you know, I think there is a grain of truth in these things. But I think the main takeaway that we want to leave you with today is that we think there are good reasons why the US trades at a superior valuation to the rest of the world. And more importantly, we think that it'll continue going forward.
And the reason why?
And the reason why is, as the theme of this presentation is, it's long-term investing for quality investing for the long term. And we think US companies are simply higher quality. If we do a comparison of US companies to international companies, the US is more focused on technology. Almost all of the major global technology companies like Apple, Google, Microsoft, Amazon, Salesforce, and you go on, they're almost all from the US because the US has a very pro-business culture that encourages innovation. This is not true if you look at indices around the world. In Canada, half of the index is financials. If you go to Europe, the index is largely banks and energy companies and real estate. If you go to China, China is a little bit different, but China is, again, very heavily concentrated in financials and these kinds of things. And the reason why technology companies deserve to trade at a premium is because they're better businesses. They grow more. They have better cash flows. They have better returns overall. Another reason why US companies deserve to trade at higher valuations than international companies is that the US remains the place that really protects minority shareholders. And I think this is something that people don't spend a lot of time thinking about because, you know, you go in the stock market and you buy stocks and you just kind of click buy and then you own the stock. But then you aren't really thinking about like, well, what do you actually own? What you're owning is a piece of a business. And actually, as a minority shareholder, which means that like I'm not actually involved in the operations of Microsoft. Like I'm just a shareholder. I get dividends and I have a theoretical claim on the assets of Microsoft. But beyond that, I don't actually have any involvement with the business. So I have to trust that the management and the board is going to treat me fairly as a minority shareholder. And this is uniquely a US phenomenon. Well,
Canada too.
Canada too, to some extent, but this is really true largely in the US, where if you go to a lot of countries, oftentimes the companies are owned maybe by a family or a handful of individuals. There's no reason for them to treat you fairly as a minority shareholder. They can pay themselves very high salaries. They can employ all of their families. They can use the company as their own piggy bank, and they're going to get rich without you getting rich, right? And so that's another reason why we focus on the US. A third thing that we like about the US is capital allocation that is focused on shareholder returns. And this is tied to the last point about managements that are aligned with minority shareholders. In the US, you have independent boards that are obligated under law to treat shareholders fairly. And they have a general preference to pay dividends and do buybacks and do these kinds of things that help you as shareholders. Again, this is not true in international markets. I was just in Hong Kong where I was talking with some investors there, and we were talking about why all the Chinese companies are suddenly investing in electric vehicles, which is kind of strange because, Tencent is a social media company. So what do they know about electric cars? And so this very smart investor, what he told me was, well, the government told them that they should invest in electric cars, right? And so as an investor, like, do you really want your social media company investing in electric vehicles, right? Like, I don't think that is going to generate returns that are attractive.
Even Elon Musk, who owns Tesla, electric vehicle company, and a social media company, is smart enough to keep those two entities completely separate.
Exactly. So that's another reason. And then beyond that, like the US is it's generally a stable place. You don't have to worry about a dictator coming in and having well, maybe we'll see. But like you don't have to worry about like revolutions, a communist government coming in and nationalizing property as we've seen in Mexico, and all those kinds of things that are risks in international investing.
Thank you, Ernest. I think you really made some great points on building the case as to why we want to focus almost exclusively on owning North American companies. So we're going to get a little bit more specific. Ernest mentioned that they're better quality companies. We'll show you some of the numbers. Why are they better quality companies? What we're showing you here is earnings growth of different country indices until 2020, or EPS growth since and you can see that the S&P 500 earnings doubled, whereas Topics, Ernest, that's Japanese, right? Or these are other indices that exclude S&P 500, European and foreign markets. The earnings from the U.S. companies have completely trounced the earnings from other indices. So what we're trying to tell you is when people say you need to diversify your portfolios, you need to own a little bit of China, a little bit of India, a little bit of Russia, a little bit of Brazil. You may not be buying good companies. You may be buying companies in countries that have lots of problems and issues and don't treat shareholders well. But most importantly, you're not getting exposure to what we think is some of the greatest trends the world has ever seen. So when we talk about quality, this is what we want to get across: is quality companies outperform. So this is what you're looking at here is the quality index versus the MSCI world. The MSCI quality index is a collection of the highest quality companies. Everybody knows the names: Amazon, Apple, Google, Visa, MasterCard, companies that are capital light, generate lots of free cash flow, have gigantic profit margins. A lot of them are focused on technology, but not exclusively. versus the regular MSCI world, which will include energy companies, banks, utilities, telecom, pipelines, you name them. It's hard to find a period going back since 2009 where quality is underperformed. In fact, it's outperformed by almost 2-1. Will that continue? We sure hope so. With the US and Canada now cutting interest rates, many people would say, what is quality? What are US companies that generate, that have these quality characteristics going to do over the next few years? Well, we've looked at history, and it shows that as long as there's no recession, what you're looking at, the orange and yellow lines represent the quality investments. They do quite well after the first interest rate cuts. If we do have a recession, it still shows that quality companies and lower beta companies, these are more consumer staple companies, tend to outperform. And if you have just some recession and no recession, quality again outperforms. So you get the thesis. Over the last number of years, going back since 2009, quality has outperformed. Prior to 2009, there really wasn't that many quality companies because since 2009, we've seen the rise of technology and technology-focused companies, whether it be the cloud providers, software providers, and we'll get more into detail in a few minutes. When we talk about quality, we're looking at companies that have a focus less on building factories or drilling for oil or trying to find copper or gold or laying cable. We're focusing on companies that are very capital light, companies that can generate a lot of free cash flow and have recurring revenues. And here's another chart that's showing the light blue line, the non-capital intensive companies. We call them the price makers. Price makers are companies that have the ability to raise prices and do whatever they like versus price takers. A price taker is like an oil company. The price taker has no control over the price of the oil that it sells. A price taker is a gold company. Gold is at all-time highs right now, so that's great for gold stocks. But if gold prices drop, the gold miner has no control. He can't sell the gold for a higher price if the price in the market is $2,000 an ounce or what have you. Just getting quickly here, we're moving on, trying to get the point across. But what are the types of companies that we focus on in the quality bucket? Information technology, consumer discretionary, industrials, consumer staples. And what you've seen here is the 10-year track record. These companies have very strong market returns and also generate the highest returns on the cash that they generate versus companies that have had poor performance over the last 10 years, companies more what we call the price takers, the real estate, the utilities, the energies, the gold miners. And Ernest said, why do quality in U.S. companies outperform? It's very simple. They invest most in technology. We're looking for our portfolio for companies that think long-term, companies that aren't afraid to spend a lot of money to try and come up with the next greatest technology. I'll give you a quick example from today's headlines. Google Cloud. Google launched its cloud business about 5-6 years ago. It was losing a fortune. It probably since it started, it lost about $10 billion building out its cloud business. Now, Google's cloud business is generating a run rate of about $7 billion a year in operating income, and we think that's going to grow by leaps and bounds. We're not afraid to invest in companies that focus on growing for the future, and we think technology is a must. It's the place to be, and we want to focus on companies that have exposure to technology. They don't have to be specifically technology names, but they have to be companies that invest in technologies. And here's another slide showing how technology stocks have done since 1985. And you can see that the world technology stocks, the thick blue line, they've outperformed all other stocks long-term, and of course, really taken off over the last few years. This dip here that you see, that was 2022. That was no fun to live through. But as you can see, these companies have come all the way back. Everybody knows that the Magnificent Seven has been driving the stock market performance. We're pleased to say that we own a fair share of those companies. No question, some of them have gone to expensive levels. But if they continue to deliver the profits like we've seen from Google that reported its earnings just today, we're hopeful that this outperformance will continue. And these Magnificent Sevens companies have the reason that they're driving the market is really the profits. So I moved too quickly, but sorry about that. So if you can look at the green line here, it's showing the profit margins of the Magnificent Seven. These companies have 23% profit margins in the second quarter. All other S&P 500 companies, 8% profit margins. Whether that means something to you or not, what will you take away, of course, is these companies are generating a lot more profits, and as a result, they're better businesses, and they should be trading at higher valuations, in our opinion, as a result. A lot of our clients will ask, why don't we own more companies that focus on dividends? Aren't dividends great, especially in Canada, where you get the benefit of the dividend tax credit? We would say absolutely for those clients that need income, dividends could be a great source of returns, but there's no reason to own a company just for the dividend if it has the opportunities to get tremendous growth. Compounding, when you own a stock that reinvests the cash flow that it earns to grow, and is certainly a much better way to grow your portfolio than owning a company that is paying a 5 or 6% dividend back to you and has no opportunities to grow, in our opinion. So we'd rather own companies that have lots of ability to reinvest the cash flows that they generate into different ways. And these are some of the examples of different ways that companies can reinvest their free cash flows. At some point in time, maybe you want these companies that are mature to start paying a dividend, but if they still have so many growth opportunities, it's way better for these companies to plow back the cash flows for more and more growth. Here's some of the companies that are in our portfolio. We're proud to say that we've owned a lot of them for quite a long time. Just giving you an example of our long-term strategy. We talk the talk, we walk the walk. All these companies that, clicked too quickly. Sorry, Ernest. Sorry, very slow here. Trying to go back. Ruining the presentation, of course. Okay. I'm so excited about the World Series. Okay, so I won't touch my mouse here. So what we're looking at here, just to finish off before I let Ernest chime in quickly, is here's some companies that our clients have owned. Some of them going back since to 2004 or 2010. We tend to hold companies for a very long time if the fundamentals are doing well. Stock prices are going to go up and down all the time. We know it. We're going to have recessions. We're going to have corrections. We're going to have pullbacks. But if we trust the management, we trust their capital allocation skills, we trust that they're doing, building strategies to grow their businesses over the next 3 to 5 years, we're going to be very, very patient with them. And we feel that patience pays off. Some of our best performers have returned 2, 3, 6, 10, 20 times our capital since we bought them. And I'm pleased to say that I own every single one of the stocks on this list. And just showing here quickly our different investment strategies that we use to invest for clients. Some of them are more focused on equities. Some of them have a higher allocation to bonds or some dividend-paying companies. We try to customize our portfolios to fit all our clients' needs. There's some disclaimers that I'll show to you because to understand some of these returns at the end of the presentation. So with that, I'm going to turn it over to Ernest to give some specific examples of what we look for in quality companies.
So I think Barry did a good job of explaining why we think the US remains the best place to invest, and especially why we think US technology companies are going to perform well going forward. And so we think that in a world when you can just buy the S&P 500 index fund, we think it makes sense for you, if you're picking stocks, to be highly selective. And what we want to own is we want to own the top 1% of companies. These are the companies that we try and evaluate. We do in-depth research on, and then we own the 30 to 40 best, highest quality ones. And what makes a high quality company? Number one, it should be an industry leader. It should be a leader that where the customers know that they have the best products, they have the best market share. They should benefit from secular trends that might be happening, whether it be things like streaming or just having the wind in your back. They should have a strong track record of making smart business decisions, whether it be creating new products, going into new markets, and doing the right thing to gain market share. Then lastly, but perhaps more importantly, it has to have a great management team that is smart, they think ahead of the competition, and they act with honesty and with integrity, especially for minority shareholders. And if you look at our portfolio, just as a whole, they're generally more profitable, they grow faster, and they have less debt than the S&P 500, and trade at a slight premium valuation, is slightly more expensive. But we think that over time, this is a good recipe for investment success. Now, I think this slide is really important because everyone says they own good businesses. There was a really smart investor who once told me that there's no one in this planet who is purposely paying high prices for terrible businesses. But in practice, what we find is that a lot of investors do exactly that. They get allured by the next big thing, whether it be things like weed stocks or cryptocurrencies. They prioritize low valuation metrics, like they look for low PE ratios or high dividend yields. They naively diversify. Like there's a lot of people who say, you have to own some gold in your portfolio. You have to own a little bit of China in your portfolio. And we think that if you understand the companies that you own and trust them to do the right thing, you don't need to do any of these things. And I think one company that really exemplifies how we think about investing is Netflix. I think most people on this call, like they know what Netflix is and are probably subscribers. Netflix is the clear leader in the streaming world. They have way more subscribers than anyone else. I think nobody would dispute that streaming overall is gaining market share against cable TV, just because you can watch shows without regular scheduled programming. There's a much wider selection. Netflix is an extremely profitable company, and I think most importantly is that they have a very strong track record of skilled management in running the business.
Netflix wasn't always a very strong, profitable company, but we had the faith that Netflix would eventually, the profits that it was reinvesting to grow its business would pay off tremendously and eventually would be the market leader. And lo and behold, that is now the case.
And if you compare Netflix against all other competitors, Netflix is just blowing them out of the water. They have the most subscribers. They're the only profitable company. And they have the lowest churn rate, which means that the least people are canceling Netflix. And the reason why Netflix is so superior to all the other competitors is because they're the biggest one. If you think about streaming, the more subscribers there are, the more money that Netflix has to invest in shows. And that makes Netflix better for everyone. Whereas if you are even a large company like Disney, it's very, very hard for them to gain the scale to have enough subscribers while being able to lose money and transition away from cable TV.
What's interesting about Netflix, Ernest, is a global company, right? So it can make shows that appeal to those in South Korea or Indonesia or whatever in terms of countries. For example, I heard that India, for example, has 30 or 40 different dialects or different languages, right? So it can make programs that are specific to those regions, to those dialects, to those languages, and something that the other streamers can't at all compare.
And most importantly is that Netflix has a really strong management team. They have a track record of making bold decisions and very, very shrewd decisions. This was very clear from the very beginning when they pivoted first from selling DVDs to entering into video streaming. And in 2022, when they started after the COVID-19 pandemic, when results slowed down, they were extremely reactive and quickly recognized that they needed to sell advertising and crack down on password sharing to drive as a measure to drive growth. And I think what's really interesting about how Netflix executed on these is that they were extremely careful and thoughtful with how they executed password sharing. And this is one example of good management. They carefully designed a program. They knew that everybody was going to be upset because they couldn't share their password anymore. And so what they did was that they created a sharing price so that if your son is going off to university, they don't have to pay the full Netflix price. They allowed you to transition your profile so that you don't lose any of your recommendations. And the care with which Netflix executed this, in our opinion, is evidence of a high quality management team. And as you can tell from this chart, from the time that we bought Netflix to today, it's done about 18% compounded, which is much better than the S&P 500, even though it has had significant ups and downs. But I think what's instructive about this slide is because we have done our research on Netflix, we had the conviction that even when things slowed down and the share price tanked in 2022, we could continue to hold on.
And we even bought more.
Yes. And we think that our research process at Baskin Wealth is a competitive differentiator that allows us to earn better results than our competitors over time. We do this by doing exhaustive due diligence into all of the names that we're buying. We do a lot of research, whether it be visiting the companies, talking with the management, talking with people, industry experts, like reading the annual reports and those kinds of things.
We have an investment committee of 11 people with an open dialogue, sharing investment ideas and making sure we're all on board and comfortable with the investment idea before we buy it for any of us, as well as ourselves. And it's very important for us to make sure that all our clients, as well as all our portfolio managers and everybody at Baskin Wealth understands what we're buying, why we're owning it, and why we're comfortable holding it for the long term. As you can see from the Ernest chart on Netflix, even though we've had spectacular results on the stock so far, it has not been an easy ride.
And here's just a few examples of me going around. So that picture that Barry's pointing to, that's Domino's Pizza's new dough stretching machine, which I don't want to bore you guys too much, but basically the way Domino's is a company that we've owned and we think it's a fantastic business. And basically by inventing this dough stretcher, they're able to automate the most labor intensive aspect of making pizza.
That's throwing the pizza up in the air. They don't have to do that anymore. Yeah.
And that's very, in my opinion, that's very innovative. Like, I don't know if you guys think this is cool, but I think it's cool.
Yeah. And that's a picture of Ernest. Well, you're not in the picture, but you went to go visit CCL headquarters. I don't think they let you take
That's
pictures.
Not the headquarters. That's just
one of their plants. You weren't allowed to take pictures inside.
No. And so if we find a high quality business, then very quickly, how do we decide when to buy it? Basically, we buy it if the shares are, if we think it's a high quality business, the shares are trading at an attractive price, and it's more attractive than something that we own in the portfolio.
Yeah, one thing we don't do at Baskin Wealth is fiddle around with pricing. Let's wait till the stock falls 10, 20, 30, 40, 50% before we get into it. I don't know. I want to pay 20 times to earnings. We are careful on valuation, and what we're trying to focus on is earning above average returns on an investment. If the S&P 500 can do 8 or 9% compound over the long term, obviously we'd look to buy companies that can do better than that without trying to take on any excess risk to achieve that. To do that, of course, Ernest and the investment team will try and figure out if we can earn those results by doing deep, intensive research and getting comfortable with the name. We won't get every name right, but if we get a few of these names right, the performance can be incredible for our clients' portfolios, as we showed you about some of those companies that have gone up 2 times, 3 times, 10 times, and even 30 times. Ernest, do you want to? We'll have a couple of minutes. Let's share a recent purchase that we made for our portfolio and our clients.
So we recently, to the point that Barry just made, we recently bought a position in a company called MSCI. It's a very high quality business. If you're interested in what they do, you can send me a message later or listen to the podcast, and we'll talk about it a little bit more. But basically, when we first did the research, we thought it was a very good business, but we thought it was too expensive. You can go to the next slide.
Mhm.
So we did our research, but we just thought it was too expensive and that it wasn't an attractive valuation. And then, so what do we do after that? We waited for 2 years. We kept following the company. We tracked what they were doing. And then we finally got our opportunity this year when they reported bad results. We're very familiar with the company and how they like to operate, and we think that the issues are temporary, and so we bought the stock.
Yeah, when we initially researched the stock, we didn't think that we could achieve double-digit returns over the long term by buying MSCI. Last 6 months, it fell to a valuation that we thought now was very attractive, and we've been watching it for a long time. We know the company for a long time, and finally was one that we were so excited to put into our portfolios. Just reported results today. We thought the results were excellent. In fact, probably the results were too good because the market, the guidance that it gave going forward was not as good as the earnings it reported. So the stock fell a little bit. But we're very excited to own this for the long term. And we can see MSCI being one of the better businesses in our portfolio. Here's our quick disclosures about the performance. Obviously, no guarantees. Any of the results that we post here. And please feel free to check out our website at baskinwealth.com. Lots more information about our performance, as well as a number of blogs, as well as videos and podcasts. Lots of detailed information. If you found any of this helpful, please subscribe to our podcast, Long-Term Investing with Baskin Wealth. We tend to put up a podcast once a week. Me and Ernest, as well as Benjamin Klein, are on the podcast. Brand new podcast will be up tomorrow, and I think you'll find it very interesting. We talk about the U.S. elections, our worries and concerns, as well as whether we're doing anything at Baskin Wealth as a result, and also a very interesting topic of looking at some of the companies that we own that just reported earnings and how stocks react to quarterly earnings. So with that, let's turn it over to Benjamin Klein and start the Q&A. Thank you very much for your attention.
Thanks, Barry. So just as a reminder, we do already have a handful of questions here. So thanks to everybody who submitted them. If anybody else has questions they want to submit, please feel free to use the Q&A function. Everybody seems to be using that as opposed to email. So it sounds like it's working well. Barry and Ernest, I'm going to try to get through as many of these as I can, and I'll give you a little summary and you can give your thoughts. So this is a long one. I'm going to try to summarize it. This is the director and chair of a finance committee for a congregation. And it's a two-parter. So part number one is, what would you say is the benefit of investing in active management versus passive? And the second, kind of related to the first, is continuity and stability of the manager is important to them. How does the firm make sure that continuity of the firm and continuity of investment management continues? Whereas, of course, investing through an index doesn't have that problem. So those are the two parts.
Ernest, you want to start off with the active versus passive question?
So I think it really comes down to what you are investing actively or passively, because certainly I think if you look at the slide about comparing the performance between the US versus the rest of the world, like diversifying in index funds in anything outside of the US has been both bad for risk and returns over the last 15 years. And I think there is reason to think that will probably continue going forward. So the benefit of an active approach is that, number one, you're owning, you understand what you own. You can, I feel comfortable that Netflix is going to continue to navigate whatever challenges that it faces very successfully. Whereas if you're buying a broad index fund, like the TSX index fund, there's a lot of bad companies at the bottom of the TSX that, like, if you are evaluating them as an objective individual, you wouldn't want to buy. And that's why I think our approach of owning like 30 stocks that, that we like and are high quality, I think will work better over time.
Yeah, in our best ideas portfolio, 30 stocks, we can't find 30 Toronto-based companies to put into our portfolio. We can't do it. So to own just the TSX index, we think is, in our opinion, is a very bad idea given our quality investing tilt. Benjamin, I think the question was about continuity of the investment management team at Baskin.
Yeah.
Well, I'm pleased to say that most of the investment management team are owners at Baskin Wealth Management, as well as much younger than myself. And we have a great team here, started by our founder and chairman, David Baskin, who has laid down the principles of how to invest as well as how to treat our clients and to make sure that our clients are always top of mind in our priority. And then our investment management approach, the continuity is very important to us. I just turned 50. I'm not going anywhere. As you can see, Ernest and Benjamin are much younger than I am, and I think they also share and very much love the quality type approach that we take for our clients. And it's one, as they can see as being business owners, makes the most sense to them when talking to clients how to invest. As a business owner, I'm sure just like myself, Benjamin and Ernest, buying shares in Baskin and owning Baskin, you can see it's a really quality investment. And if you wanted to buy quality investments for your portfolio, for your client's portfolio, I'm sure they share the same philosophy there. Anything you want to add, guys, on that?
I think that's really it. I mean, we take a team approach. You can't. Every individual person has their own risk, whether it's health or something else. But as a firm, we're owners. We're here for the long term. I have 2 kids in private school. I'm going to be here for many, many decades. So we want to make sure there's as much continuity as we possibly can.
All right.
So next one's interesting. It's not really stock related. It's actually a question about fixed income in a portfolio. It's a question from a person who is retiring in 2 years, is currently 100% stocks, and wants to know, in short, what are the pros and cons of bond funds versus something like cash or a money market fund?
I think I think that's a question for the head of financial planning to answer.
Okay, good one. So the question here is really about cash has sometimes delivered negative returns. Bonds have also had negative returns, particularly in both 2021 and 2022, of course, which was the worst year in history for bonds. In general, I mean, I think cash is, for the long term, almost certain to deliver worse returns than bonds are. I mean, cash is, when you think about investing in a cash fund or a cash ETF, what does that cash ETF in turn invest in? It's investing in very short, safe bonds. So kind of on a secondary level, you really are investing in bonds. You're just investing in exceptionally safe and short-term bonds. So the returns on a cash ETF are almost certain to be worse over the long term. Whereas in the longer term, bonds, especially if you're investing in investment grade, decent credit quality bonds, should be comparably safe to cash. Of course, it's more volatile. I mean, cash is typically not volatile at all. It doesn't swing at all in value. But in the long term, you should expect better returns from a bond ETF. There are, of course, hundreds, if not thousands, of different bond options with different durations, different maturities, different credit qualities, and which is right for your portfolio is a much more complicated question. But hopefully that was an insightful overview.
Yeah, and obviously, if you are thinking of retiring in the next 2 years, speak to your financial advisor, speak to your portfolio manager. If you have concerns about how much stock exposure you have in your portfolio, given the strong performance over the last 2 years, so maybe you feel like it's time to reduce some of your portfolio allocation, especially as you're getting older. Absolutely worth having that conversation and think about. At Baskin Wealth, we try to customize portfolios to meet clients' risk tolerance, liquidity, goals, long-term objectives, and try to make a portfolio that fits and suits them. Obviously, bond yields are not the most attractive after fees, taxes, and inflation, but certainly reduce the volatility in your portfolio. Next question.
So we've got about 10 minutes left. Let's try to keep them a little bit shorter so you can get to as many as we can. So a question here about gold. So there was, of course, a brief comment about gold in the portfolio. Question is, could you explain why the rise in stocks and gold price rising at the same time? Do you think gold is a good option to include in a diverse portfolio for the long term?
I think Ernest already answered the diversification about gold question earlier in the presentation. But Ernest, since you mentioned gold, you can talk about it.
Gold as a physical commodity, I think we're very unlikely to add to portfolios because gold by itself, unlike a company is always making money, right? And when they make money, they are able to pay dividends and buy back stock and invest in growth and all those kinds of things. Whereas gold doesn't do any of that. It's just metal, right? I think one thing that we will do and are open to doing is if there's a very well-run gold company where the management has a great track record. I don't even know if this is possible, but like they have a great track record of finding gold or something like that, then I'm certainly open to it.
Yeah, I think one of the reasons why people buy gold, Ernest, is they're worried about the devaluation of the dollar. They're worried as a result of inflation, and they want to own something tangible that can protect against that. Our answer back to that is why not own great quality businesses that have the companies that we call the price makers, the companies that have the ability to raise prices when they want. They have lots of growth opportunities and can reinvest the free cash flows that they generate into higher return ventures. And so we feel over the long term that the best way to protect your portfolio against the devaluation of the dollar, against inflation, is to own companies that we talked about tonight, quality companies for the long term.
Next question, had a couple. Sorry, go ahead, Ernest.
Oh, sorry. I think there was a question at the bottom of why we own oil stocks.
Well, we own one oil stock.
Given the point about price taking and price making.
Yeah.
And I think the point is that generally, yes, you rather own price makers rather than price takers, but there are high quality oil companies like Canadian Natural Resources and Tourmaline Oil, where they are going to make money in any environment. And the management team has a great track record of creating value for shareholders. And I think that's basically all there is to it. Like I wouldn't say we're so close-minded as to say we'll never own, an oil company or anything like that. And so we think that these are companies that will do very well.
Great. There are two questions on Couche-Tard, so I think it's a good idea to talk about that. The questions are, number one is, what happens if they do not succeed in buying 7 and I, it's a 7-Eleven? What will be the next steps to increase shareholder value? And basically, what are the other one is more general. What are our thoughts on the possibility of them completing the deal?
It's my favorite topic. I like talking about companies a lot more than
yes. And we've done 2 podcasts already on Couche-Tard. The first podcast we did was an overview of the company when we purchased it, and then we did another podcast when they did the surprising announcement of trying to acquire 7-Eleven, the parent of 7-Eleven in Japan. And Ernest, go ahead.
Yeah, I think where we're at with the 7-Eleven deal is we'll see what happens. They made a proposal and they went to Japan, but the management didn't want to meet with them. And so they didn't even really respond. So like whether or not there is going to be a deal, I think is a very open question today. I think this is one of those scenarios where if they are able to do the deal, we've talked about it on the podcast where obviously we think it's a great deal and would be very good outcome for shareholders. But if they don't end up doing the deal, then Couche-Tard will simply be in a position to buy back more stock at a lower share price. And that's a pretty good outcome as well. So I think you win either way.
I think the stock obviously is under pressure because of concerns about leverage with the deal, as well as possibility of issuing equity. And and so that's put a lot of concern on the share price for now. We think in any event, as Ernest said, Couche-Tard can do very, very well, either acquiring 7-Eleven or going back to their original business of focusing more on North America and Europe and making small tuck-in acquisitions going forward. We like the business very much and think the share price here is very attractive.
next one. I'll just read it verbatim. Recently, you mentioned the sale of CNR and Vail. My question is, Baskin Wealth has reiterated its long-term approach regarding stock picking. At the time of these purchases, these were long-term holds. How does your strategy shift with the changing landscape? When do you consider a stock to no longer be a long-term investment?
Yeah, so that's a great question. And we try to make money here for our clients. So that's the focus. And so to own the best companies that we think will generate the best returns over the long term. Generally, Ernest and his team are always on the hunt for the best ideas that we can put into the portfolio. And if we come up with a better idea, we're generally looking for a name to exit. So it's less about getting rid of a stock and more about that we are excited about a new investment idea that we think will deliver better returns than what we have. We did a great podcast on CN Rail and Vail as to why we recently sold those companies. We did hold them for a long time. Their results recently have disappointed, and we think that those companies are going to face some challenges versus the new purchases that we made for our clients' portfolio. Let's go to the next one.
Ernest, what are your favorite investment-related books?
That's a good question. My favorite investment book is The Innovator's Dilemma. It's by Clayton Christensen. I think it, for those of you who haven't heard of this book, is considered the Bible of innovation in Silicon Valley. And it really talks about how high quality companies can get disrupted by doing the right thing. It's a very it's a very detailed book, and I think you should read it. I think it's a must read in the business world. In terms of other books, I generally focus more on business case study books rather than generalist investing books. Like the Nike Shoe Dog book was really good. Like there's a Couche-Tard book. There's Hunter Harrison wrote a couple of books on the railroad industry. Like these are the kinds of books that I generally try to read.
Here's another quick one because I think it's a fun question. Does Barry and Ernest ever plan on writing a book?
No.
I thought that might be the answer.
No, I don't think anybody reads anymore. I have young kids. I've never seen them read books, so I don't think there's a big market for books going forward. We love doing the podcast. We love doing these type of webinars. We love going on TV and sharing our insights. Ernest, you haven't even written a blog lately. Get to it, man.
We can turn our podcast bind it up and put it into a book.
I've seen some people for it. Yeah, I've seen some people do that. We got time for one more question, Ben.
Okay, so I'm going to go with quantity because we had two questions on Dollarama. So if you want to give your thoughts on that stock.
You want me to talk about it?
I've only been in the store once in my life, so you can talk about it.
I think Dollarama is obviously a great business and one that we've looked at several times and incorrectly decided not to buy. I still think it's a great business, but it's just not more attractive than what we currently own.
Yeah, when you own a portfolio, you're always trying to a new idea. You're always trying to figure out if it's better and more attractive than what you already own. And no question, Dollarama has been a beautiful business model. I can't believe they've been able to dominate the Canadian market for so long. They're looking for growth now outside Canada into, I think, Peru and Mexico. Those things come with risks, and we're not so sure we want to pay that high a multiple for a retail company. And so right now, our best retail choice in our portfolio is Costco. So Benjamin, I think we're going to end it there. We like we said, we've recorded this. We'll be sharing it very shortly on our website and on our YouTube channel. And we really thank everybody for joining. I want to thank Ernest and Benjamin for helping with the presentation tonight. And we really appreciate everybody at Baskin Wealth, the whole team that helped to prepare this presentation. And we hope that we can do another one of these more regularly. Our last one, we did a presentation in October 2022. Actually, it turned out to be we timed the bottom of the stock market right before the bull market started. So we're hopeful that this will mark another bull market. So everybody have a good night, and we'll see you real soon. Take care.
Thanks, everybody. Good night.